Pay off your debt right now. Whatever you have to do, make a plan to pay it off. Follow Dave Ramsey if you need to. Pay off your debt. This time is here now. You can see it a mile away. We're going into a phase of inflationary times. This is not growth. This is deflationary. It's going to happen all over the world. You can see it's coming, man. And if I'm wrong, then you're out. You still have no debt. Whatever. If I'm right, I'm just telling you we have history to show you what happens if you're in debt in a deflationary time. And remember, deflation doesn't mean the prices of everything goes down. It just means the general economy suffers and you're losing. And we're going to go into this, but just hang in there. I'm telling you, man. Deflation doesn't mean everything is cheaper. That's good. No, deflation is the Great Depression. That gives us an example. Now, we could have a deflation kind of like Japan in the last 30 years. That's a different type, and who knows? Who knows where we're going to be? But I'm telling you. So let's just start with this. This is from Zero Hedge. No, not Zero Hedge. This is from Seeking Alpha. Trouble is brewing in China's property market, which is coming off a major debt-fueled building boom. Debt-fueled building boom. A liquidity crisis that was headlined last year by the default of China's Evergrande has only gotten worse, and the country's largest real estate developer failing to deliver a preliminary restructuring plan. Eroding confidence in the property sector saw sales of the country's top 100 developers plunge nearly 40% last month. Millions of people across China are experiencing trouble in their homes being finished on time, and a growing mortgage payment boycott in more than 90 cities threatens to exacerbate the situation. The debt crisis was already unstable before the current crunch, and with the average mortgage payment making up over half of a buyer's monthly income, looking to revive the sector, China is now working on a nearly $150 billion bailout fund to complete stalled property projects and head off a backlash by angry homebuyers. Interesting, the bailout isn't aimed at helping highly indebted developers. It is rather targeting local governments or local government-owned entities to take over projects and apply for loans from the Bank of China. Concerns remain over the strategy's efficiency, given the fact that local governments already struggle with completing projects, and how older creditors like suppliers, contractors, bondholders will be stacked up in the event of new financing. All right. Cities in China are already struggling with severe debt loads as they shoulder much of the expenses related to education, infrastructure, and healthcare. The property market slowdown can force more local governments to rein in spending. Rein in spending is not growth-oriented, adding yet another drag to China's weakened economy, which expanded by just 0.4% in Q2. The chance of a vicious cycle, declining housing sales and prices, mounting developers' distress, and deteriorating local government finances is concerning from growth and financial stability perspectives. Okay, the chance of the chance of a vicious cycle, declining housing sales and prices, on top of the fact that cities in China are already struggling with severe debt loads. Does that remind you of anything? Mounting developers' distress and deteriorating local government finances. Does that sound like anything? So we're going to go over here, watch this video. My man, uneducated economist Simon here. Chinese manufacturers face crisis from excessive inventories. And he's been talking about China a lot. Anyway, so we're seeing here. Oh, yeah, by the way, China. Let's just take a look, shall we? We're going to look at trading economics and so see how big the U.S. factory growth slows less than expected. That's okay. But we're going to see, China, the second largest economy in the world. Now, per capita it's not, but per capita is way low. But in terms of because China's so big, man. You've got 1.4 billion people. So it's more than 4 times the size of the good old US of A. Look at that, though. Their second largest economy. All right. What does that tell you? That tells you that if that refracts, if that slows, stops to go in a recession, to go into a Great Depression, that's going to affect everything, man. How many United States people, how much do we have invested in China? I don't know the answer to that, but what I'm just saying is that's going to affect everything. It's not good. All right, so let's keep going here because I'm going to go back to to this right here from Squared Away blog. Yeah, pretty liberal place. CRR, Center for Retirement Research at Boston College, very focused on race. It's embarrassing. It's like, it's rich white people because they're all focused on race. I mean, the amount of these people, how they focus on racial stuff is mind boggling, man. It's crazy to me, but be it as it may. This is a good article. At least they cite it. Too much debt taxes baby boomers' health. You got this guy right here. Work, bills, payments, debt. Work, bills, loans, work, overtime, tired, money, work, debt, mortgage. Okay. Staying healthy is becoming a preoccupation for baby boomers as new medical problems arise and the existing ones worsen. I don't know about that, but either way. The stress of having too much debt isn't helping. Older workers and retirees who carry debt are less healthy than people who are debt-free. Older workers and retirees who carry debt are less healthy than people who are debt-free, and higher levels of debt have worse health effects, according to the Urban Institute. Now, Urban Institute is lib, but that doesn't mean they're wrong. But always, anything you got to take everything from perspective. Where's the end point here? Where are they pushing us? And that's the same thing with if you want to look at Heritage Foundation or AEI. It doesn't matter. What's the end point here? Anyway. The type of debt matters as well. Unsecured credit cards have more of an impact than secured debt. Right, that would be a mortgage or a consumer loan would also be a car loan. Now, this is a little bit misleading. I like it. I think it's true. It's just a little bit misleading. Older Americans fall deeper in debt. Another day older and deeper in debt. St. Peter, don't you call me, because I can't go. I owe my soul to the company store. Anyways, we got in 1998, in today's dollars, adjusted for inflation, we had 40,000 was the median debt levels for people, I think, over 55. Yeah, for all homeowners and renters aged 55 and older, the median debt level is 40,000. And we fast forward to 2016, the median debt level was 62,000 or something like that. In of itself, that doesn't bother me all that much because median, 50% of the people have more, 50% of the people have less. But also, let's take a look. Just look at total household equity in the United States. And we can see 1996, this is in billions of dollars, $5.3 billion. I'm not sure how much is that 5.3 trillion. I don't know. But you can see it just, let's actually make this log. Hold on just a second. We're going to format this. We're going to log it. There we go. You always want to log it to give you a little better. But anyway, so you'll see here in 1996, it was right there. And we've gone up from, was that 4.5 billion or trillion? Probably trillion. I think it's trillion because it's in billions of dollars. Yeah, it's going to be trillions. Anyway, so 4.5 trillion to, where the hell are we at now? Freaking 27 trillion. So we've increased our net worth by 7 times. And yet our, the median debt that's not 2016. So it was 4.5 trillion in 1998. It was over 15 trillion or so in 2016. Anyway, so we quadrupled that's just equity on your home, even though our debt went up by 50% or so. So the median debt, and that's everything. So it's deeper in debt is a little bit misleading, but still, because it is. What is the value of your house? What's your net worth? Just because you're falling deeper in debt doesn't mean you're not having increasing net worth. Anyway, they're very misleading, but I don't want to poo-poo the idea that debt is detrimental to your health. All right. Debt can erode an individual's health in various ways. The stress of carrying a lot of debt has been shown to cause hypertension, depression, or overeating. Hypertension, high blood pressure, the whole thing. It can be a challenge for people to take care of themselves with onerous debt payments and can't afford to buy health insurance, or if they're insured, pay the physicians and drug co-payments, or they just eat too much because they're freaking depressed, man, or they drink too much because they're depressed. So this is an issue because the share of people over age 55 with debt and the dollar amount of the debt has been rising for years. And this population increasing bankruptcies have been the fallout. In the analysis of 2 decades of data comparing older workers and retirees with and without debt, the researchers found that having debt is tied to the borrower's declining self-evaluations of their mental and physical health. 100%, man. The more debt you have, the less you just don't feel as good, man. And as such, your declining self-evaluation of your mental and physical health. Older people who are in debt are more likely to be obese, to have at least 2 diagnosed health conditions, or suffer from dementia or various ailments. The bulk of their debt is in the form of mortgages, which increasingly have strained household budgets in recent decades as home prices have outpaced incomes. Piled on top of larger mortgage obligations can be payments for credit cards, medical debt, car loans, and college stuff. The size of debt burden also matters. People with debt to asset ratio that exceeds 80% are much more likely to be diagnosed with two or more health conditions. All right, so debt to asset. Ghost, see that ghost? I just got to show you. Hey, boys. Oh, are we boring you? Did you just sigh? Oh, no. Are we boring you, boys? So a debt to household asset ratio would be simple. You have your house is worth $100,000 and your total debt is $80,000. All right. And so your whole assets are worth $100,000. Your total debt is $80,000. That's an 80% debt to household. Now you don't like that, or debt to net worth, frankly, is what it is. Or you can even say loan to value. That's more used for a specific property and real estate. But debt to asset, your total assets, your home, everything is $1 million, and you owe $100,000. That's a 10% debt to asset. On the other hand, everything you own is worth $100,000, and you owe $80,000. That's an 80% debt to asset. I mean, it doesn't take a rocket science to realize the more debt relative to your asset, the more stressors are going to be. People with debt to asset ratio exceed 80% are much more likely to be diagnosed with mental conditions or health conditions. Yeah. All right, so that's not good. We don't like that. That's bad stuff. Their debt can cause obviously financial, but mental and physical health problems. All right, so you're gonna have a hard time going into retirement with heavy debt load, especially if you're relying on the stock market, because you're like, my 3.5% mortgage, I can get better than on the markets. Well, maybe, but that's a hell of a lot of risk you want to take, especially in a market that is starting to slow down economy. China is falling apart. Japan is in the world. Let's see what Japan's bonds are doing right now. Let's take a look. Here's Japanese still under negative interest rate policy. The Bank of Japan maintained a short-term interest rate at -1, 10 basis points. The BOJ reiterated it will not hesitate to take extra measures it needed, a sign that it will remain an outlier among a global wave of central banks tightening. The central bank has mentioned it would continue to buy unlimited amounts of the bonds to defend an implicit 25 basis point cap every market day, as it's been doing since April. So the Bank of Japan is going crazy. Actually, I wonder if we can see here. Hold on a sec. Massive increase in the debt to GDP here. This is just 2020 as well, before the BOJ said we'll do whatever we got to do to keep the interest rates low. And we'll notice that this does not have any effect on the growth of the economy. It's just not moving. So I'm sure there's a place there we could find out if we can see the actual amount of credit central bank balance sheet. Let's see. I'm not going to find it because it only goes back to. All right. Anyway, so the point being, let me just see. Again, here's the inflation rate of Japan. Just not much. I mean, they have a little bit of a jump there, but let's put it this way: hard to see Japan having huge inflation when everything else is falling apart. In terms of China is falling apart, the United States economy is slowing down. The EU is definitely a basket case with high energy costs and whatnot. All right, so the point being is health is wealth. If your health is bad, one of the reasons why is probably because you have debt. So I just want to go back. I'm going to read you from this again, because the lessons that could be learned in Days on the Family Farm, just any kind of old school book that talks about, like through the Great Depression, the Roaring '20s. I'm just going to read you a couple things. So this is from chapter 4, Down on the Farm in the Roaring '20s. Abundant employment opportunities and the new availability of installment purchase plans encourage consumers to buy now and pay later. Again, this is the 1920s now. Buy now and pay later. By the end of the decade, businesses and consumers alike believed that a new era of perpetual prosperity had been achieved. Herbert Hoover took over in 1929 before that vision was shattered. Let's see. The number of farmers in America shrank to only 25% of the population by 1930. The culture divide between rural and urban areas grew. The Coolidge prosperity did not extend to the business of farming. Farmers watched their farm values fall, while their urban neighbors reveled in the amenities of a new material world. So the farmers are sitting back saying, our farm values are falling, while you guys over here partying. The 1920s did not lead many to say, the Great Depression is right around the bend. They said, I can buy now and pay later. In fact, here's Yale economist Irving Fisher. He famously predicted 9 days before the crash that stock prices had reached what looks like a permanently high plateau. He stated on October 21st that the market was only shaking out of the lunatic fringe and went on to explain why he felt prices still had not caught up with the real value and would go much further. Isn't that interesting? So here's, now look, no one wants to be this guy. Everyone says it's easier to say the market is going to fall and be wrong because you can keep saying it. But if you say the market is going to go up and you're wrong, everyone remembers you for sure. He's an American economist, eugenicist, and progressive social campaigner. He was one of the earliest American neoclassical economists. And this is where let's just put it this way. Some of the, I don't want to say right wing, but libertarian is not very, you can hold that into some degree of wonder, like, why are you guys like this? Because I'm going to show you something right here, because we're going to just go back to this real quick. And this is, I did this in the live stream last night, which is why you need to be on my live stream. There's How to Cut Food Costs by Lena Francis Cooper. Now, nothing, it's just interesting because this lady turned out to be eugenicist as well, along the lines of Margaret Sanger. She was big in the Kellogg clan, even though she wasn't a Klansman, even though she wasn't part of that clan. But the guy who founded Kellogg cereal, not a good man. Read up, just a disgusting POS. And I bet he was funding Lena Francis Cooper's research to promote cereals, which of course has been just devastating in obesity here in the United States. And she's very anti-meat as well. Anyway, so let's go to Fisher, because we're going to show you something here. This will tie in, trust me, because we're going to go to Irving Fisher, see what we got. Oops, right here. Right here. But let's see. It can be seen then that meats have no place in a more economical diet. But one will say the economical diet must at the same time be efficient. This is a perfectly true statement. It has long since been proven that a non-meat diet is conducive to efficiency. Irving Fisher of Yale conducted a series of experiments using as subjects a group of non-athletes selected from the employees of the Battle Creek Sanitarium. These sanitarium is just basically the Seventh-day Adventist hospital. It's not like the loony bins. Most of whom had not eaten meat for several years. And then he compared them to a group of trained athletes at Yale. It's such a silly study that proves anything because you can easily manipulate the data here and cherry pick who you want. But anyway, the non-meat eaters far excelled the meat eaters in endurance in spite of the fact that meat eaters had the advantage of training over the non-meat eaters. Okay. Anyway, so let's go back to Irving Fisher because we're going to just read real quick. We talked about, progressive social campaigner. So a lot of these libertarian economists back in the day were very progressive, if that makes sense. You know what I'm saying? Like not very humanistic, very eugenicist, probably a lot of racists. And we know Margaret Sanger was. I bet Lena Cooper was. I bet Fisher was. So I don't know. But anyway, you can see where I'm going here. All right, what does that have to do with the debt? Well, because again, going back to here, abundant employment opportunities and the new availability of installment purchases encourage consumers to buy now and pay later. And what was Irving Fisher saying? That the stock market had not plateaued, had reached we shook out the lunatic fringe, and now it should keep going higher and higher and higher. All right, so let's keep going here because this is going to get kind of ugly here in just a second. Think about in the context of what we talked about with China. Before the end of 1920, the long period of rising farm incomes and farmland values came to an abrupt end. Farmers produced at expanded levels to satisfy export demand. Farmers produce at expanded levels to satisfy export demand. Think about China, man. Or not China, man, but China folks. To satisfy export demand during the war and early post-war years. But when demand for exports dropped off, farm prices collapsed. Could something like that happen? Demand for exports falls off as people are losing their jobs here. Where do we get our exports from? China. And what's the one thing they're having a hard time with? They're heavy in debt too. You think they can do what they do and it won't affect us? You crazy? Farm prices in 1921 continued to plunge In December 21, Elmo sold hogs for less than $7 per hundred. In 1919, hogs sold at $20 per hundred. The price of some farm products held up a little bit better, but not much. On average, in the United States, farm prices fell by 44% from 1919 to 1921. Thereafter, farm prices improved only modestly through the rest of the decade, settling in the late 20s, about 1/3 below the wartime high. All right, what does that have to do? Keep thinking this. Farm prices fell by 44% in 2 years, man. All right, here we go. In 1920, the average farm in Illinois, consisting of 135 acres with buildings, had a value of $25,000. A decade later, the average Illinois farm had grown to 143 acres, which is basically 10 acres more. So that's 440,000 square feet more. It was only worth $15,000. All farmers watched the value of their land fall, but those who had bought land during the speculative land boom during the war and early post-war years found themselves struggling to make mortgage payments. Thus, farm foreclosures during the period of 1913 to 1920 averaged only 3 per 1,000 farms. But during the Depression of 1920 and 21, 450,000 farmers lost their farms, or about 7% total. By 1925, average farmland values in Illinois were down already more than 25%. All right, so, I mean, think about this, man. If you were watching your farm go down in value on top of a market going down in value, stock market, all right, on top of people unable to work, you're having less. Your job might be at stake as well. All these things are stressful. They're stressful. The prices of your house. Oh, you bought in a speculative bubble. And it's not a bubble. I mean, it still provides you a shelter. I get it. But you still have this debt hanging over your head. And what if you lose your job, man? What if you get hurt? What if the price of your house falls 10 to 20% and your mortgage is still out there? I mean, 10 to 20% isn't a pop of the bubble. It's significant, don't get me wrong, but my goodness, man. Especially if your loan to value is like 90 to 95%. We get a house that's getting ready to go up the market over here. It sickens me to think what they're going to sell that thing for. Crazy. They bought it 5 years ago for like $755. I can't imagine what they're going to sell it for now. And I'm like, who is this money coming from to buy it? It's coming from the mortgagers, the people who are borrowing. And we know for a fact, we studies that debt leads to insecurity, health, and mental. Let's keep going. I want to point something else out as well here. Let's read this. Access to electricity was also created, this is in the 1920s, was creating a booming market for new appliances. In 1929, electricity had reached 63% of all the U.S. population. Refrigerators, toasters, and washing machines followed the availability of electricity. All available for installment purchases. Buy now, pay later. All available with installment purchases. Throughout 1931 and 1932, the picture was similar across the country and indeed around the world. Some say the weakened state of Europe as a result of the war and attempts to maintain the international gold standard were more important factors in the Great Depression than the U.S. stock crash. In any case, international finance was in chaos. Many countries, including Britain, were forced to abandon the gold standard by the end of 1931, but the U.S. still clung to it. In the meantime, the U.S. economy went down. Investment fell to almost nothing, and any new investment was overshadowed by depreciation of existing buildings and equipment. Production fell by 30%. Prices, wages, and salaries are all falling. Between 1932, roughly 12.5 million people were out of work, nearly 25% of the nation's workforce. The Dow Jones hit the bottom in July 1932 after suffering a 90% loss. So just put that in your pipe and smoke it for just a second. All right, because check this out. Farmers across the country were hit hard as a group. And I know I'm talking about farmers. Think about people who are heavily leveraged right now. Ooh, farmers across the country were hit hard. Farm prices were still falling. While commodity prices fell 25% from 1930 to 1932, the price of farm products fell by 45%. During the war, Elmo sold hogs at $20 per hundred, we talked about. In 1932, he sold it for less than $4 per hundred. No one has enough money to buy. During the war, he sold hogs at $20 per hundredweight. In 1932, he sold it for less than $4, 12 years later. Hog prices and many other farm prices were down to levels not seen since the 1890s. The Farm Board failed at its attempt to support the prices of wheat and cotton and abandoned the effort outright in 1932. The low farm prices made it extremely difficult to pay back loans taken when prices were high. That is the epitome of deflation. The low prices that you're receiving for your labor, would it be a farmer, be it digging ditches, be it doing YouTube stuff, it makes it harder to pay back the high values that you took when the prices were higher. Deflation kills debtors. I mean, we're talking, they haven't seen hog prices and many other farm prices are down to levels not seen since the 1890s, amigos. This is the 1930s. The risk of, from an average foreclosure rate. Remember, so we talked about foreclosures before. In the 1910s, it was a 3.2, I think is what it was. One sec, see if I can't find it. Let me see if I can't find it. One sec. In 1913 to 1920, 3.2 farms per thousand were foreclosed on. Then it went to 7% in 1920 to 1921. All right, let's keep going here. From an average foreclosure from 1926 to 1930 is now up to 16.7%. Farm foreclosures climbed to 28% by 1932. So the course of less than a decade, basically the foreclosure rate quadrupled. Actually, even before that, it was like 3.2 to 7 to, 16 to 28.4. Literally in the course of 15 years, it went from 3 per thousand to over a quarter, 28.4. What is that, 7, no, 8, 9? 9 times? I don't even know how you say that. Quintupled times 2? The risk of foreclosure was severe but selective. Only those farms that were heavily mortgaged were at risk. The risk of foreclosure was severe but selective. Only those households that were heavily at risk, were heavily in debt, were at risk. In the United States as a whole, 42% of farms carried mortgages. In the United States as a whole, X amount of households having mortgages on their home. In 1930, that is. And most of those are manageable, i.e., they weren't heavily leveraged. They had a lot of equity. Of those farmers who were indebted, a third had a high ratio of debt to value. And they're the ones who risk default. Those states with the highest percentage of farms mortgage included Iowa, Wisconsin, a bunch of others. And they're the biggest ones that had the biggest amount of foreclosures. I'm just going to read this quick. Farm wages were heading lower with everything else. Across the country, on average, farm wages fell by 45% from 1930 to 1932, which is the same decline in farm prices. In 1932, this guy worked for $30. I'm not sure I got that highlighted. I'm not sure what he had before. He worked for $30 a month, whereas before he was working for $35 a month in 1931. All right, let me just highlight that. So he started work for this guy in 1931 at $35 a month. In 1932, he worked for $30 a month. Gross farm income fell, 50% over the same time. It was the lowest level of farm income since 1909. But in 1909, farm income actually covered expenses. All right. So not only is being in debt is financially risky because of all, I mean, literally, if you go into a deflationary, depressionary period, you're screwed, man, because you borrowed when the prices were high and you're paying back when the prices are lower, when your income is lower, because that's what happens. I just told you. And then if you're heavily leveraged, you don't have enough equity. You say, I can't afford it. The interest payments are killing me, man. I know it. Everyone, mom says, the market's always out. It has until it hasn't. I mean, we're talking, these people had the same amount of income, the prices from 1890 they did in 1932, and yet if you're borrowed to buy your farm or your house in 1919, at the top of it, you're freaking SOL. Same thing here. Never even forget that all that stuff. If you just have debt as a whole, you're gonna have a hard time sleeping at night. You know this, I know this. Pay off your flipping debt. Look, I got a mortgage on this guy. I think about it all the time. I say, man, I should just sell everything, pay off everything. You know what I'm saying? The problem is I got 10% penalty to do that, but I tell you, I'm getting closer to that by the day. If I get about 2 more years of a good stock market run, that's probably what I'll end up doing. Just paying off everything, being done with it. Because as long as I have my house paid off, I know, look, electricity can be high and we'll lose less electricity. Property tax will be high. You're always going to pay property tax. You know what I'm saying? And you have a vote in that measure anyway. What else? And then you could, if worst case scenario, you can sell it. You don't have to worry about freaking paying off a banker. I'm just telling you, man, pay off your debt. It'll improve your health, improve your wealth, and and then you don't have to worry about this crap. All right. Love to hear your thoughts. This is important stuff, man. And again, if I'm wrong, let's just say I'm wrong. I don't think I will be. But let's just say I am. But Josh, I paid off my debt. Oh, it's not a bad thing. But Josh, I paid off my debt and I missed out on 25% increase in my portfolio value. Yeah, okay. Wow. I mean, that's literally the worst thing. I paid off my debt and I missed a stock market run. Okay. I mean, imagine your assets will have your house will have run up too. But Josh, I paid off my debt, and now the market's down 90%, a la the Great Depression, and I don't owe anything anymore. Yeah, it's gonna feel a hell of a lot better. Oh, look, you still gotta keep some cash. I'm gonna need cash on the side to buy stuff. I grant you. I'm not saying freaking have no cash. I'm just saying at the end of the day, it's getting crunch time, man. I can feel it. Again, I could be wrong. I don't know. I'm just telling you. This is what I'm really think hard about this. If you are in debt and the market falls at the same time you lose your job, you are SOL. Don't be SOL. All right, we'll see you.